Let us look at this scenario or question. So we have Boachi Industry PLC. It's a manufacturing company listed in the Ghana Stock Exchange. You are the financial reporting manager and have been asked to prepare the earning per share disclosures to the year ended 2023 in accordance with IAS 33. The following movement in ordinary share capital occurred during the year. So these are the financial financial position, and it has all the transactions. So opening balance in shares 12,000. They issue no share in April 2,000. Bonus issue 2,800. Right issue 3,000. And they did repurchase and cancellation in November 2023. So that is a summary of what of their purchases, and below detailed the information they will require. All right, so they have what market price issue they issued on 1st April. So the above is a summary. So the elaboration is here. So on 1st April 2023, the company issued 2 million new share at the price of 450 pesos. Bonus issue was also on 1st July 2023. The company capitalized reserves and made 1 for 5 bonus issue and right issue 1st October 2023. Company offered the right issue to existing shareholders on the basis of 1 new share for every 4 shares held at a subscription of 2 80 pesos, and the market price share immediately before the right issue was forced to do 20 pesos. Then they did purchase and cancellation on 30th November 2023. The company repurchased and immediately canceled 800 shares at the prevailing price of 5 CD 10 pesos. Profit and preference dividend were declared. So the profit is 18.6 million. The company has in issue 3 million irredeemable 8% preference shares. The preference dividend has been paid for the year. We have share option dilutive. As at December 2023, outstanding options held by senior management to subscribe 1.2 million ordinary shares at 3 CD per share. The average market price of ordinary shares during 2023 was 4 CD 80 pesos. The options meet the criteria for inclusion in dilution or in diluted earning per share under IAS 33. Comparative period ended 2023. The basic earning per share for the year ended 2022, as previously reported, was 0.95 per share based on one's weighted average number of shares, 12 million shares, and earnings of 11.4 million. No transaction occurred. Required. Calculate for the average number of shares, basic earning per share, restated basic earning per share for the comparative year. Calculate the diluted earning per share, taking into account the outstanding share option described in number 6 show working. So this is the question. All right, so let's zoom in. So the company name is Boachua Industry PLC. So first they say we should find the wins. So that is A. So how do we find the wins? So you pick your your period and the shares were. So you have your shares. You also have your months when the purchase was done. You do your adjustments. Then you weight your shares. Good. So let's start. So in the question, do we have outstanding shares? Yes, we have outstanding shares. Now let's go in there. We have outstanding shares. When you look at it, the outstanding shares was what was opening balance 1st January 2023, 12 million. 1st January 2023, 12 million. So you have what 12,000 here. Let's go. Did they buy another share? Yes, they bought full market price share on 1st April. So when we come to addition, it is there. So 1st April 2023, the company issued 2 million new ordinary shares at the price of 4 series. Right. Okay. That came on 1st April. So that is what new issue. 1st April 2023. How much? 2 million. And you sum it up. What do you have? 14,000. Then the next one is what? Let's check. Did they buy new share? Yes, they did bonus issue on 1st July. come to additional information, and the total bonus issue is 2,800. Don't just pick it, work it out yourself and verify. So let's say 1st July, the company capitalized reserve and made 1 for 5 bonus issue on 1st July. Good. So 1 for 5. So you come here, bonus issue, and it was what, 1st July 2023. Let's confirm that. Yes, 1st July 2023. Bonus issue 1 for 5. Okay. So you pick your odds. 1:5. That's what it means. So you pick your odds. You do 1/5 multiplied by the odds. By the outstanding shares, the immediate outstanding share of what? 14,000. What do we have? When you multiply, what do we have here? So when you multiply 1/5 times 14,000, that gives you how much? 2,800. Let us confirm from the table. That's what you have here. You see it 2,800, right? Confirmed. Then you sum it up. So when you sum it up, what do you have? That gives you 16,800. Then let's see if they did issue another one. Yeah, they right issue in 1st October, 3,500. Come to the addition from it is the right issue 1st October 2023. The company offered a right issue to what? To existing shareholders, right? And the ratio is 1 for every 4 shares that they hold. Okay. And right issue came with for 2 prices, right issue price and then one market price. All right, take note of that. So you come here, right issue, and it was what, 1st October 2023. Confirm that it is there, 1st October 2023. All right. And the ratio was what? One, that is what is there. 1 for 4. 1 share for every 1 share, 1 new share for every 4 shares. All right. So when you are done, also you find the number of shares in issue. So that gives you 1/4 times the outstanding share, which is what? 16,800. What do we have? So this one also gives you how much? 4,200. So you sum it up. What do you have? 21,000. Okay, let's see. Now, when we go into the table, you realize that they said that there is a repurchase and cancellation on 30th November, 800,000. Okay, come here. It is there. They did repurchase and cancellation 30th November, and it is 800,000. So you come here, you say what? Repurchase. All right, that one is what? 30th November 2023. Okay, and how much was it? Repurchase 800,000. Okay, so when you less is what do you have? So you have what? 20,200. So then you can say what your total share left at the end of what accounting year 2023. Okay, so let us go and then what apportion the dates or the months. The asset was or the shares was acquired. But, we have outstanding share on 1st January 2023, and new share was acquired in what April. So how many months before the new issue? It's 3 months before the new. So you have 3/12 here. Now, when we come to the outstanding here, this outstanding is supposed to go to 12 months, but a new share was acquired along the line. So then we have to make a stopover here. So you will have what from April to June. How many months? April, May, June. So April, May, June, 3 months. So multiply here also 3/12. From July to October is how many months? July, August, September is also 3 months. So this outstanding was also 3/12. Then lastly, from October to December is also okay. So from October to December, this one are going to October to December, but there is a cancellation in November. So between when the last outstanding to when it was cancelled is how many months? It's only 1 month or how much? 2 months, right? Okay, so October beginning to the end of November is what is 2 months. So here we got 2/12. And then lastly, this outstanding will travel to the end of the year, which is up to December. From November to what? December is what? Is 1 month. Okay, so we're done with what? With the apportionment of mass. So let's look at the adjustments. There are adjustments to be done, right? There are adjustments to be done. We have right issue and we have what? Bonus issue. And these ones comes with what we call bonus factor or fraction. The same applies to this one, bonus fraction or factor. Okay, so how do you go about it? So the bonus issue by this and right issue. So the right issue was what? 1 for 5 shares. And the bonus is what? 1 for 4 shares. When you go to the table, you see them. When you come to the table, it is here. Bonus is what? 1 for 5. And then right issue is 1 for 4. Okay, let me confirm that. Bonus is 1 for 5. And right is 1 for 4. That is fine. Okay, so if so, all right. So you have it here. Right is what? 4. Then bonus is what? 5. Now, each of them, we have to do what we call retrospective what adjustment to previous outstanding. If not, their values, your weighting what will be wrong. Because remember, there is free shares that has been issued to the existing shareholders. So there is no price. That's why you do what you call retrospective what application or adjustment to the existing share that was issued and paid for. Now, when we come to the right issue, we have what we call home right price theoretical extract. In short, we have TER theoretical S right price. Then when we come to the bonus factor is also is what? Is the ratio all divided by the existing what? Shares. Right. So this is how we use what to find their bonus factor and fractions. So when we come to the bonus factor, that one is simple. You pick the bonus factor will be what? Be the ratio, which is 1 plus 5, divided by the existing share, which is 5, 6 over 5. When you come to the right issue, so that one too, you have what? A bonus factor to what? To be the what? The cum right price over T. So here we know our cum right price to be the what? The old, so the cum right price is what? Is equal to what? To the old or the market price of the share. And then the T is what is defined. So how are you going to do that? So first we have we know our cum right price to be equal to what? Now let's go into the question. So the right issue, they said that at a subscription of what 2 cedis, so they are giving the people 2 cedis for the right issue, and the market price before the right issue was 4 cedi, 20 pesos. Okay, so here this is what they are talking about. You have your market price of the share before the right issue is how much? Market price was 4 cedi, 20 pesos, and then you have what right issue price, which is what 2 cedi, 80 pesos. So what they mean here is that the market price of the existing shares is bought at 4 cedi, 20 pesos. But the right issue, how much they are giving to the existing shareholder 2 cedi, 80 pesos. So the cum right price is the market price, which is how much? Which is 4 cedi, 20 pesos. The TER is what we don't know. So let us find it here. So how do you find the TER? So you come here, you will have your shares, you have your share price, you have what the value. So you have your old share and you have your new share. Now, how do you have that? They gave you the share ratio, the right issue ratio to be what? 1 for 4. That's the ratio. So 1 is so it means we are giving you 1 share for every existing share you hold. So if every existing 4 share you hold, so it means the 4 cedis are old share I'm holding, and they are giving me new share of 1. That means the old share is what? Is 4, and then the new share is 1. And the price tag, the market price 4 cedi is what is the old share price, so which is 4.2. Then it will come to a new share. They are giving them at the price of what, 280 pesos. So here, when you multiply, give you 280 pesos. So this one will give you what, 16.8. And you sum them up, that will give you 19.6. Then you sum the share, that gives you what, 5. So now you can have your TERE equal to what, 19.6 over 5. That gives you what, 3.92. So that means your TER is also defined. So you have what, 3.92. Now, so this one you can decide to leave them in fraction or in decimal. So 6 over 5 is what, 1.2. This one to 1.07. Okay, so we've had it. So this is what you are going to use for what, for the adjustments, as I've earlier indicated. So you come here. Now you will multiply. Listen very carefully. Let us start with what? With the bonus issue adjustment, or the fraction to be adjusted to the bonus, to the table. So here, the bonus issue factor of factor is how much? The bonus issue factor is how much? 6 over 5, or 1.2. Okay. Now take note of this, that when you are doing that adjustment, adjust to the what, to the outstanding shares, prior to the what, to the issue of what, of bonus, or what, the right. Now let's go in. So let us pick the bonus first. The bonus fraction factor is 1.2. So here you will pick it. You multiply by the first outstanding, 1.2. Now there's a new issue. So the outstanding, next outstanding is what, 14,000. So you multiply by what, 1.2 here. And remember, the next outstanding is what, 16,800. However, remember, there is what, there is a bonus, and it includes bonus issue. So for that reason, you will not adjust this outstanding. As earlier indicated, adjust the outstanding that are before the what, before the bonus issue. So here you will not adjust here. So here what? So here you will adjust nothing. So possibly you can say maybe no adjustment here, right? Or you can leave it, or you can put dash here. Okay. So after that, the rest of what? The rest of it will not be adjusted. After that, the rest of what, of the outstanding will not be adjusted. Now let us pick what? Also right issue. When I pick the right issue, what is the fraction? The fraction is what? 1.07. Okay, let us do the adjustments. That one, you will start from here. You will multiply 1.07 first outstanding times 1.07, right? Good. Then you will come and also multiply by this one, which has what? Bonus issue. You understand? You are multiplying it because it is not right issue. But this one is what? It's right issue. So you are multiplying it because it is what? It is right issue, but not bonus issue. Right now, the next one is right issue. Now the right issue, the fraction from right issue will not be what? Will not affect the outstanding after the right issue. So here will what? Will be, or no adjustments. Or you can say no what? Adjustment. Here too is after the right issue. That one too is what? No adjustment. You understand? So that is how the adjustment is what? Is made. So you should take note of that. Okay. So the first standing is what? 338.52. Now let us multiply the next outstanding. You have 14,000 times 1.07. This one will gives you 4,494. 1644 3 over 12 times 21,000. So when they did that repurchase of shares, so you have these shares outstanding. All right. When we sum it up, what do we have? Again, I'm looking at something here. I will advise also that when we are doing the adjustments, the bonus factors, I will advise that keep it in fraction when we put it in decimal, it will affect your calculation, right? So I'll prefer we keep it in fraction here. So with this one, 1.2, 1.2 here, let us keep them, all of them in fractions. It will help the calculation. If not, the decimals will affect the values. Okay, so let's look at this one. The fraction is how much? Let's look at the fraction. The fraction is the bonus fraction is 6.5. So let us keep it that way. So here it was 6 over 5. All right, so 6 over 5 here, 6 over 5 here. All right, then let us look at the right issue. That one is 4.2 over 3.9. 4.2 over 3.92. Okay, 3.92. 4.2, 3.92. Okay, that's it. So, all right, so this place will give me, so that is what I'm talking about. So here will give 7, right? So here will give me 4,500. So take notes. Leave them in what? In fraction, not in decimals at all time. Leave them in fraction. If not, they will give you different values. So here will give me 4,500. It is what? 4,500. Okay. Here will give you 18,000. Alright, so this is your what? This is your wins. So now we've done the question number 1. So we calculate the wins. So they said we should calculate the basic earning per share for 2023. What do we have here? I under the A. They said we should calculate the basic earning per share. Basic earning per share is what? Profit less what? Preference what? Dividend. All divided by your wins. Right? Okay. So let's go in there. In the question, do we have profits? Do we have profits? Yes, we have profits. Profit declared in the question is how much? But they declared profit. How much is the profit? The company's profit after tax for the year was 18.6 million. Okay, so the profit is what? 18. And then there's what? There is preference dividend. There's preference dividend in that. How much is the preference dividend as declared? The present dividend, so the company has in issue 3 million irredeemable 18% preference shares, and the dividend has been paid. So you have what? Preference shares. Okay, so we have preference shares. So how do we get our preference dividend from our preference shares? Okay, so we have our preference shares. Our preference shares is what? 8%, 3 million. So 3 million. I've already hanged 3 zeros, 3 million. If so, then we can get our preference dividend to be how much? So the preference dividend will be 3 million times 8%. That gives us how much? 240. As we now know our preference dividend was 240, then we can now find our basic earning per share, which is what? The profit. The profit is what? 1,600 minus preference dividend of 240, all divided by the wins. The wins is how much? 180.40. So that gives you what? 1.02 to your basic earning per share. All right, so now that we know what our basic earning per share, what next? What did they ask? They said we should find the restated basic earning per share for the comparative year 2022. Okay, I. The restated basic earning per share for the comparative year 2022. They want us to restate the basic earning per share for comparative year 2022. Why do we have to restate 2022 earning per share? When you look at 2022 and 2023, basic earning per share will differ because of what? Right issues and then what? And bonus issue. Because in 2022, they didn't issue, based on a they didn't issue any right issue and then bonus issue in 2022. But 2023, they issue what? Both right and then what? Bonus issue. When right and bonus are issued, it affects the previous what? Outstanding. The reason why when you have right issue and bonus issue, you need to what? You need to get the bonus factor to what? To readjust the previous year's account, the previous year's outstanding shares. That's what we call what? Retrospective what? Adjustment, right? Because bonus and right issues, they were issued to the existing shareholders either for free or part of it paid. So when we take right issue, part is paid, part is for free. And bonus issue is what? Is virtually what? Is free to the ordinary existing shareholder. They didn't pay for it. So when that happens, the previous accounting year that was paid for need to be adjusted. If you don't adjust retrospectively, your weighting will be overvalued. So you need to adjust retrospectively. That means the previous outstanding, so that your weight will be fair representative of what happened within that period. So for that reason, in 2023, right issue and bonus issue were issued. And 2022, they didn't. So if you have what? Basic earning per share for 2022 and basic earning per share for 2023, comparing the two will be mismatched, because it is not a fair representation of what happened in 2022 compared to what happened in 2023, because the weight for the shares in 2023 it was weighed differently to 2022. So for the reason why when you issued any bonus or right issue, you need to do adjustment to the previous basic earning per share as well, so that comparing the two basic earning per share will be fair on its merits or judgment. If you don't do adjustment for the previous basic earning per share, the basic earning per share for 2022 and 2023 will not, or will be will be incomparable. It will be incomparable. Understand? It will be incomparable, because the metrics used in in 2022 and 2023 are different, because of bonus issue and the right issue. If so, then you need to adjust the previous year's basic earning per share with the right issue and bonus issue, so that both can be on the same thing for analysis purposes. So with this one, as given, we have two ways of determining or doing the restatement. Now, let us look at the first one. So here, if you are given basic earning per share, so let us look at. So when we look at 2020, they've given us 2022 information. So here, they've given us profit 11,400. It is in the question. See, it is there. They're giving us profit of 11.4 million, and then the wins or the shares is 12 million. Okay, 12 million. All right. So we can find our basic earning per share to be what? To be the profit, all divided by what? How do we have? We will have 0.9. So this is a basic earning per share. So here, this is what they've already provided that for us. That this is what the basic earning per share for the previous year 2022. And they're giving us all the information to calculate to determine that value. So that is what I have done here. So that's 0.92. So how do we restate this 0.92 so that it can be comparable to 2023? So retrospective adjustment of basic earning per share for 2022 will be what? So here we are. Outstanding shares for 2022 is how much? They're giving it to us in the question. It's for 12 million, right? Then you come and do your adjustments. The adjustment were bonus issue that affected the weight, and then right issue. So what were their factors? So with bonus issue, it is what? It is 6/5, and right issue is what? 4.2/3.92. We have two methods in determining. So with this, when you are done, then you multiply by what? You multiply all of them by what? By the outstanding shares. That is simple. So how do you do that? You will pick what? 6/5 multiplied by 4.2/3.92 multiplied by the what? By the outstanding, which is 12 million. right? So you multiply this all together. So when you multiply, what do you have? When you multiply, you get what? 15, 40, 42, 8.6. So you realize that now we've had our new outstanding shares. You see, so now we had our new outstanding shares. Since we have our new adjustment share, now you have adjusted wins. That's how much 1528.6, and we have our our profit after tax to be what to be so 11400. Okay, so now we can calculate for our basic earning per share as adjusted. That will be what 4400 all divided by 1542.8.6. That gives you what 0.739. All right, so this is your basic earning per share after the adjustment. Alternatively, you can what? You can calculate and arrive at the same as using this method. Now, two things happen when you are what? You want to use this alternative. First, we know our basic earning per share for 2022, which we want to restate, which is how much? 0.95. In order to restate this, you pick what? Your basic earning per share, multiply by what? By inverse of what? Right issue and what? Bonus issue factors if they are in what? In fraction. I will demonstrate that. Or basic earning per share divided by right and bonus issue factors if they are in what? They are in decimals. Let me demonstrate that for you to see them. The first one, we have what? Basic earning per share 2022. How much? 0.95 times right issue and bonus issue factor. So bonus issue is 6 over what? 5, right? Bonus issue is what? 6 over 5. The inverse of it will be what? Will be 5 over what? Over 6. But when you look at it, we know the what? Bonus factor will be 6 over 5. And then they are here, right? They are here. Bonus factor and then bonus fraction for right issue and then fraction for bonus issue. So they are here. Now we say that the inverse of it, right? Okay. So the inverse of what? Bonus factor is what? For bonus issue is 5 over 6 times the inverse of what? Right issue factor, which was what? 4.20 the over 3.92. The inverse of it will be what? It will be 3.92 over what? Over 4.2. What do you have? It will be what? 0.739. Is the same as the above. Have you seen it? Okay. Or you have your what? You have your bonus basic earning per share 2022 being what? 0.95 if it is in decimals. So in decimals, it means that I have to multiply the bonus fraction issue and then right issue. So you have what? 6 over 5 times what? Let me put it this way. Let me convert them in decimals. So decimals. So you will have what? 6 over 5 times what? And 4.2 over 3.92. What do you have here? 1.286. Good. Now we can what? We can restate it. So you have it here 2022 is what? 0.95 divided by what? 1.286. What is the outcome? It's what? 0.739. So you see, all of them what will give you the same outcome. So we are done doing the restatement. So we will have what? Our 2022 here, 2023 here. Basic earning per share will be 2020 0.739 and then 2023 what? 1.02. Good. So that is it about the restatement. B, they say they calculate diluted earning per share for 2023, taking into account the outstanding share options described in what? in those sticks. So calculate the diluted earning per share. Okay, so diluted earning per share now. So that is B, share option. This under IFRS what 2, and this is also referred to as equity what settlement. At a point, a company may decide to reward its what existing employees or employees, directors, management. So they can use for share option arrangement what to motivate them. In that sense, they can give the shareholders what shares to be part owners of the company. That's what we call equity settlement. So when they give them shares what to be part owners of the company, in that process it dilutes the basic earning per share. When we say dilution, it means a share that are given to people. It could be workers, employees, it could be even business transaction, that I'll give you equity shares of my company so that you become part owners of the company in exchange for either your service or maybe a business transaction. So when that happens, the company that is giving out the shares will receive no cash in returns. So when that happens, it dilutes the basic earning per share. Because, as an example, if you have profit of 200 and you have shares of 400 shares, now you realize that your basic earning per share will be what? Will be your profit over your what? Over your shares. So here, what will be your basic earning per share? That will be 0.5. Okay, so now maybe along the line, the company said that, okay, let us give our employees shares. You see, within the account, so let us give our employees shares. Okay, so when we give them shares, maybe they give them what? Share option of maybe 40 shares. Okay, so at the end of the day, what will this one do? This one will add up the existing shares, which is what we have already 400 plus what plus the share option that you're giving to the what to your employees, which is how much 40. So to give 440. So when you're coming to calculate your new basic earning per share, what do you have? You have your profit will not change, all divided by what? By the diluted. So this is what we call the dilution. So you realize that now your basic earning per share has reduced to 4.5. Earlier it was what? It was 0.5. Now it has reduced to what? 4.5. This is what's called diluted. See, earning per share. Right. So this is what the question wants you to find out about dilution when you introduce shares to people for free, or they made part payment and then part of it is also free. So with regard to share option, we have two methods in determining that. So let's follow up with the question. What did the question say about it? So the question gave us all that we needed to know to determine whether there's a dilution of the question. Okay, so let's see. Let's go into it. So now when they gave us what? Share option. Share option is how much? The share option is 1.2, that's 1,200. And they've given us what? Exercise price. What they mean is that if the management want to what? Decide to accept the offer, this is how much they've given them what? They've given to them to what? To buy or to pay for the share option. So the exercise price is 3. And the market currently, if the share is what? It should be traded in the market, it is what? 4.5. It is in the question. Alright, so this is what they gave us in order to determine whether there's what the dilution after the share option. So what do we do? Now we have two methods in determining this. So the first method, so that's option one. Option one, step one. Calculate the percentage of what? Of dilution. Percentage of dilution is what? Is market price minus what? Minus exercise price all over market price times 100. Okay. So in the question, they've already given that to us. So they give us our market price will be 4.5 minus exercise price is what? 3. All divided by 4.5. What do we have? Times what? Times 100%. What do we have? That gives us what? 3.3%. Then 0.2. Calculate the number of what? Of shares. How do you calculate the number of shares? It is what? The share option given to you multiplied by what percentage and what in dilution. The share option they've given us what the share option. The share option of 1,200 or 1.2 million in the question. We have 1,200 here. Multiplied by percentage in dilution. That the 0.1 that we calculate what is what? 33.3%. What do you have? That is 400. When you are done, that what you find your what? Your wins. Your wins, you already have outstanding shares in the question. The outstanding shares is what is the outstanding share is what we've calculated here. 180,040. That is the what outstanding shares. Because we've already calculated it. So far, this is the outstanding share pending with the company. Okay, that is what 180 40 plus the what? The share option converted, which is what? Which is 400. When you add, what do you have? You have 18,440. So you can calculate your for what your diluted earning per share to what to be your profit after what after tax less what preference dividend all divided by what your wins. What is our profit after tax? Check here. It is in the question. They've given us our profit. How much is our profit? Our profit was given to be how much? Okay, so 0.5. They've given us what? Profit of what? 18.6. And they've also given us what? They've also given us the preference shares and then what? Dividend preference shares and what? 18% preference shares of 3 million. They've given us 3 million irredeemable 8% preference shares. Right? So clearly we can know our what? We can know our profit attributable to us ordinary shareholders. So here, watch, you need to be very, very careful at distance. So we know our profit. The profit is what? 18.600. And they're giving you a preference shares, right? So the total number of preference shares 3 million, which is what? 300. And the unit price of the share is what? Preference share is 1. So first, you need to calculate and know the value, because at a point, if you are not careful, you just go and pick the value as they are. You may forget that they are what? They are not in what? In value, but in numbers. You see, but they're giving you what? A price per unit. So when you multiply, what do you get? I give you 300, right? So now you know the value. Okay. And according, they also give you what? A percentage. So now this is what? 8%. You know what preference. So how do we get? So this is what the value in what? In the investment. However, they've also given us what? They've also given us 8% preference dividend what to be paid. So how do we get that? So you will just pick the total value. So preference dividend will be what? Will be the 300 times what times 8%. How do you have? That gives me what? 24. Alright, so now that we know so this is our preference dividend. So here we can now calculate our profit less what preference dividend. Because to be 18 minus what? Minus 24. That's how much. Alright, so I think this one is preference should be 3 million, right? Okay, so here should be 3. So here will be 240. Okay, let me align this. So here we got times 8%. Okay, so here 240 is equal to how much? We can now calculate our what? We can now calculate our diluted earning per share. Okay, that will give you what? 1/8 profit of 18,600 minus what? Minus preference dividend divided by your wins. So your wins, when we calculated diluted wins, how much? 18,440. That's 18,440. So our diluted earning per share is how much? It will give you 0.995. Which is what? Which is equal to what? 1.0. Okay. Now, alternatively, you can calculate your diluted share option. We can calculate it this way. But first, determine share options and what in value. Now, they're giving you share options to you how much? 1.2 in the question. The share option outstanding is what? Is 1,200, 1.2, which is 1,200. And they're giving you what? Exercise price, which is how much? 3. 3. So when you multiply, that gives you what? 3,600.2. Determine the number of shares. If the shares is bought back. This is simple because we know the market price of what of the share. When the share is floated to the market for sale, how much is it going to be bought? So here you will pick the word the share options in value, the one that you calculated. I calculated here right now, 3,600. Divide by what? By the market price. The market price in the question, they said the market price of the share is what? 4.5. What do you have? It will give me 800. Then the determine what? Determine the incremental in what? In dilution. So this is what shares. So how do you do that? You will pick the word share options in shares as given. That was what? 1.2200. And then the shares if bought back. The one that which is 800. So when you less it, what do you have? You have 400 shares. So this is what we call incremental. Now, what's this? This 400, is it not the same as the first one? Look at the number of shares after the, is it not the same thing? Watch it, look at the calculation of number of shares. I was saying 400, you see. Then you go ahead and then what? Determine your wins. Your wins is what? Outstanding shares, which is how much? 180.40. Then you add this what? The shares of what? 400. That gives you what? 184.40. So we can now find out what diluted earning per share. So we already know our profit was 18,600 minus preference share, which is 240 divided by what? 188. But the answer is what? 1.0. So now you know our basic earning per share is how much? Is 1.02, and our diluted earning per share is now what? 1.0. All right, so the financial statement, this is what? Dilutive. Right, so if your diluted earning per share is less than the basic earning per share, we say that it is dilutive. But if your diluted earning per share is more than the basic earning per share, we call it what? Anti-dilutive. Now, if it is dilutive, we will report this in the financials. But if the dilutive earning per share is more than the basic earning per share, then they will report the basic earning per share rather in their what? In their books. For example, if you have what? If you have your basic earning per share to be 1.02 and your diluted earning per share is 1.06. Clearly, dilution is what? Is more than what? The basic earning per share. So we call this one anti-dilutive. So we will not use this one in our financial. They will still rely on this. But in this instance, this is what's dilutive. So this is what they are going to report in their financials. All right, so that is it. So that is all about this very question. We've answered it all. Thank you very much.